Okay, today I want to talk about Elliott wave, and I want to talk about Elliott wave theory, and uh, we will see how I can apply it, or rather, we can apply it at the end of this video. We can apply it to live trading. So, one most important thing that Elliott wave theory pertains, it is the structure. So, the key to using Elliott wave theory successfully lies in correctly counting of the waves. If you have these waves, market moves in such like waves. So the key to using Elliott wave successfully lies in correctly counting of the waves and identifying the wave in which the market is currently trading in. So how do you find Elliott wave in real time? How do you find Elliott wave in real time? One of the key points of Elliott wave is the concept of fractal nature of the markets. What is the fractal nature? What is the fractal nature of the market? The fractal nature of the market is simply uh, defined as rather price tending to repeat themselves over and over again. If you look at any chart, any given chart, you'll see that market price will tend to repeat itself, over and over again. So we have under Elliott wave theory, there are two types of price progressions. And we have one which is the motive wave, and then we have the corrective wave. The motive wave is if you have this. So the motive wave is this impulsive wave rather. It is also like an impulsive wave, and then we have the corrective wave. So what is the impulsive wave? So under impulsive wave, we also have uh, three subwaves. We can divide it into three subwaves, which we can have something like a zigzag pattern, or we can also have triangles. We can see triangles forming in this impulsive wave. At the same time, we also have the corrective waves, which we can also divide into three patterns, or rather three subwaves. We have the zigzag waves, zigzag patterns, and all that. So this is the Elliott wave structure. When you have Elliott wave structure, we have this wave 1, then we have wave 2, then wave 3, wave 4, and then finally wave 5. And then wave 5. So under this wave structure, we have the principles which we call Elliott wave principles, So what are these principles? These principles are rules that even if they are broken, then we simply consider that wave as invalid. So the first point, the first rule is wave 2. We talk about wave 2. It cannot retrace more than 100%. Wave 2 cannot retrace more than 100%. More than 100% of wave 1. More than 100% of wave 1. Then we have the second rule being wave 4 cannot move into the territory of wave 1. Wave 4 cannot move into the territory of wave 1. Then finally we have wave 3 cannot be the shortest wave. The third rule, that is wave 3 cannot be the shortest wave. Amongst wave 1, 3 and 5. Why wave 1, 3 and 5? Because wave 1 is an impulsive wave, wave 3 is an impulsive wave, and then finally we have wave 5 also is an impulsive wave. So these are the rules. Wave 2 cannot retrace more than 100% of wave 1, and wave 4 cannot move into the territory of wave 1, and wave 3 cannot be the shortest wave amongst wave 1, 3 and 5. So what happens in this scenario? If wave 2, this wave 2, if it moves more than 100%, as I'm showing right here, then we consider that a wave invalid. If wave 3 becomes the shortest wave among this wave, and this wave, Elliott wave is invalid. Again, if this you are seeing wave 4 retracing up to a certain level, if it retraces up to this point, then we consider also this wave invalid. Why? Because this area is the territory of wave 1. This area is the territory. From this point we are seeing the territory of wave 1. From here up to here we are seeing territory of wave 1. So having that in mind, this leads us to how we can tell, or rather explaining each and every wave in detail, each and every wave in detail. So wave 1, when I talk of wave 1, during this wave, price begins to bounce higher. Like you can when you look at this price pattern, market moving from downtrend finally to uptrend, we are seeing market begins to bounce higher after a long sustained downtrend. So the tip here is, most people see this as a just retracement of this large downtrend. Most people see this as the retracement of this bear trend. So most of traders, will begin to short this trade from this point. They will short, but then they will be stopped out when this wave will not turn out to be a retracement, rather a beginning of a new wave. Then we have wave 2. Wave 2 will move into wave 1, or rather will retrace a portion of wave 1. Wave 2 will retrace a portion of wave 1. When we are talking of retracing portion of wave 1, you know it can be a retracement up to around 78, even 90, but not more than 100%. Wave 2 will retrace by either 50, always 50 or 61, or even 78. When you draw Fibonacci from this point up to this point, you will see wave 2 retracing around 0.50% or 61 or even 78 at maximum. At most it will retrace around 78. And then we have wave 3. Wave 3, when you talk of wave 3, This wave offers the largest potential for profit because it is the longest wave. Always it is the longest wave. Yes, it cannot be the longest, but again it cannot be the shortest, but it always is the longest wave. Why? Wave 1 swing high is broken. Wave 1 swing high is broken, and then after break of swing high of wave 1, the price begins to move higher or rather accelerate upwards as more and more traders recognize the bullish sentiment. As more and more traders recognize the bullish sentiment. When price breaks at this point, most of traders now will begin to buy this trade or stock, whichever. Additionally, many sellers will have their stops triggered at the high of wave 1, which adds further fuel to the upper price momentum. So tip here, if you identify wave 3, join the trend as quickly as possible in order to take advantage of the explosive move. If you identify that this was wave 1 and then you see wave 2, which you will identify because price will tend to retrace around 50 point or 61 or even 78, join quickly to take advantage of this explosive move. And then we have wave 4. Wave 4 will follow wave 3 and will retrace a portion of wave 3. Always it is the shallowest wave retracement. It is shallow. It will always retrace at least, or rather at most, if I can say at most, 38%. If you take your Fibonacci from this point, you will see it will always retrace around 38%. Notice that you should be careful when taking positions during wave 4, as you will likely lose money due to the directionless market. This wave, it always has a choppy move, or rather choppy. It can always be flat wave also, and you can lose money around this wave when you are taking trade positions around this wave. But again, if you have to, I would advise trade with the trend. Then finally we have wave 5, which completes this impulsive wave. Wave 5 which completes this impulsive wave. So at this wave, almost everyone is bullish. So it is easy to identify a trend. You are seeing market moving, making higher highs, and at least you will know that this market is in a bullish momentum. So again, wave 5, you will see most of the momentum around this point will be reducing. This is where you find market diverging. We have the high, and then when you look at momentum, or momentum will be reducing as market is making higher highs. Momentum is making lower lows. Momentum, you can also check on it on using MACD or anything of sort. We have divergences, how to measure divergences, which we'll talk about later in this channel. So after this completion of impulsive wave, we have corrective wave. We have corrective wave as wave A, B, C. A, B, C. So wave A basically is just the same as wave 1 in the beginning of this upward momentum. Then we have wave B, which again is just a copy of wave 2, and then we have wave C, which basically is the characteristics, as most of the characteristics of wave 3. Again, the checklist, which is very important, you should always know the checklist. We have wave 1 and wave 1, 3 and 5 are trending waves. Wave 1, 3 and 5 are trending waves. You must make sure. Wave 2 can retrace up to 99% but not 100%. Wave 4 should go into the price areas, should not go into the price areas of wave 2. Wave 4 should not go to the price areas of wave 2 or wave 1, if you like to say it. Then wave 2 and wave 4 must display alternation. This is where I wanted to talk about most alternations. Alternations we have right here, wave 2 and then wave 4. Alternations can be in this manner. Either one will be deep, another will be shallow, or one will be simple wave, simple retracement, another one will be complex retracement. That is the alternation. Again, in terms of time, one will take the longest time to retrace. Let's say something like this. If you measure from here to here, it has taken a lot of time. Then wave 4 can take the shortest time. Those are the alternations of wave 4 and 1. That is the corrective waves. So up to this point, let us go and see what we have in GBP USD. GBP USD, if you look at GBP USD, you are seeing market was in a sustained or was in a downward momentum up to this point. Then we are seeing market making these higher highs. Then now market is right here. We are seeing market is beginning to make the upper move. So why do I consider this as Elliott wave? The right way to measure this as the Elliott wave. We have this point. We have this as wave 1. Then we have wave 2. Then we have wave 3. Then we have wave 4. Then we have will simply buy it up to this point. Okay, characteristics of wave 2 and wave 3, wave 2 and wave 4. We said we are talking about alternations, and alternations, talking about alternations, we have this as wave A, B, and then finally we have wave C right here. Then we have wave 3, which is the longest wave. Then we have wave 4. Wave 4 is the simple correction. And if you take Fibonacci, you will see that market is trying to reverse around 38. Market is trying to reverse around 38. We are seeing this point. Yes. So market is trying to reverse around this point, which is the point 38. So from here you can simply make a position, take a position on this trade, and you can buy this position maybe up to around this point, because this is the highest This is the highest of these. We are seeing market making a new highs at this point, so you can take advantage of this trade. This is the immediate, or rather the live trading currently running on GBP USD. You can take advantage of this trade. About where to get in or where to exit, where to set stop loss, I don't want to talk about that right now. We'll talk about that later. But if you are to look at this trade, at least be on a bullish perspective, or rather a bullish bias. Thank you for watching, and I hope this has been helpful.